Markets are pretty choppy lately.
It can do even better and broaden out to other sectors, especially if
What is a smart portfolio mix?
80% invested in equities. Things you want versus the thing you need. Set up a barbell approach. You can do that across other asset classes.
You got the power.
The markets are pretty choppy lately. What is your insights, your outlook on that?
We're living and reacting to every headline about trade with China. So that's one piece of the puzzle that continues to cause enough uncertainty for investors to look at JP Morgan and Morgan Stanley and Goldman Sachs. All great reports, but no real actual change in equity prices. As a matter of fact, largely ignored. Estimates for the S&P 500 earnings for this quarter, 6% year over year. We came in closer to 10% for the last 2 quarters, and I bet we're going to come in closer to 10% for that. So I think the market hasn't priced in the tailwinds that we have. So when you put all those pieces together, there's been more headwinds than tailwinds. The market's done fine because of the artificial intelligence revolution. I think the market works its way higher into the end of the year and broaden out to other sectors, especially if the Fed continues to normalize rates to become less restrictive.
Got it. What is a smart portfolio mix? I mean, how should investors allocate their assets under this kind of environment?
Obviously, this all has to do with your time horizons, how long before you need this money. But let's just say the average person who's 25 to 45 years old, investing for their future, both retirements and the big purchases that they're going to make, like housing and education. I think the best thing to do is still to be 80% invested in equities. The 5 is cash or cash-like, right? And the 15% is different fixed income vehicles. Of the things you're going to invest in equities, I think it's important to have the things that you want versus the things that you need and keep them balanced every quarter. Things that you want artificial intelligence. So those names that are the artificial intelligence players, you could build a basket of those or there's an ETF. The things that you need are things that are actually going to help balance this out depending on economic activity. So what do we need? We certainly need healthcare. That would be part of the bucket that you would put in this. And I think healthcare is an amazing value right now. Energy, trading at an incredibly low valuation right now. Here's my barbell. It's the boring stuff over here, but we need it. The exciting stuff over here that everyone talks about at cocktail parties. But if one of those gets out of whack and at the end of a quarter you rebalance that, you're actually taking profits, which people forget to do in the high-flying internet darlings. You're putting it in on a gradual basis into the stabilization of the things that we need.
What sectors should investors really keep an eye on?
The only sectors of the 11 sectors in the S&P 500 that are trading at all-time highs right now, for obvious reasons related to artificial intelligence, are technology, communication services, utilities, and industrials. All of them are adjacent to artificial intelligence. Of the other 6 sectors, they're all underperforming the index. So there's a much better chance that a company that's in financial and materials or healthcare, the cyclicals and the interest rate sensitive stocks will start becoming the leadership, not just in the fourth quarter, but into the first half of next year. So think about things like housing related stocks, all very interest rate sensitive, financials that do better with net interest income. Most importantly to me, the small caps have outperformed since that July jobs report because of the likelihood that we're going to see interest rates coming down.